Hey gang, Akil Stokes here. It is Thursday, which means you are stuck with me once again for another live room weekend review, or I guess weekend review, a little more than the live room. I do the syndicate as well. I've had an extremely busy week of trading, and I told my live room gang this morning that I don't remember the last time or if I've ever taken this many trades in a single week. And it may have something to do with the new aggressive approach I've been taking. It could just mean the markets are waking up, but I fired off a lot of trades this week. So I've got a lot to discuss in this week's video. So I'm going to still try and keep this thing to 25 minutes max if I can. Hopefully I can cover everything I want to. If not, maybe I'll break it up into a two-part series or just get just do a really good job of editing this. But what I want to talk about this week is I want to take a look at equity curves for one. I want to take a look at I guess the true equity curve, the realness, the what happens inside of an equity curve, and kind of the psychological battles that go with that as well. I want to talk about multiple trading strategies because, again, I told you I took a heck of a lot of trades this week, and I'm pretty sure I used every trick in my arsenal. So I've got some examples from some syndicate videos and some recorded live room sessions that I'm going to share with you, demonstrating some of the techniques that I talk to you guys about on a weekly basis. And I also want to talk about more in psychology. I want to talk about dealing with a losing streak. Now, I actually drew myself out of a drawdown this week, which is good. But I've been reading the book Pitbull, and there's a really good section on. It was a heck of a mistake he made. I won't go back and I won't go into the whole book, but it's a really good passage on dealing with losing streaks that I think would be beneficial for every serious trader to hear. So if you're serious about trading, I think it's worth listening to. So if that wasn't enough, all that and more on this week's weekend review video. Hey guys, as I mentioned earlier, I've got a jam-packed weekend review for you guys, and I'm going to start by showing you a flashback video of some of the trades I took during the week, demonstrating the multiple techniques that I talk about each and every week in the live room, in the syndicate, and in this review video. But I want to start off by talking a little bit about me and how my week is gone. It has been a good week. It's definitely been a really wild ride, but overall it's been a good week. Ended the week in profit, or I guess the week's not over yet, but I'm in profit right now, in the green right now, or in the black right now, and dug myself out of a pretty good drawdown. And I say it's been a wild week because I have taken a lot of trades. I'm not sure if it's, again, because the market's moving or if it's the aggressive technique I've been using, but I've taken almost 25 trades already this week. And just to give you some perspective on that, when I was day trading, when I was working mainly on the 5 and 15-minute charts, I averaged about 30 trades a month. So that should tell you how active this week was. The positive is that within those 25 trades, again, I got to get a lot of experience on the new aggressive entry technique I've been working on. I also got to showcase to live room members and the syndicate members the power of all of the different techniques that we teach. And it's pretty cool. So what I'm going to do right now is I'm going to flash you back through some of our syndicate videos, some of our recorded sessions from the live room, and we're going to take a look at some simple patterns like double tops, double bottoms, 26-18 trades. I'll see if there's any advanced patterns in there that I can throw in there. Those are usually pretty boring, but see if I can get one for you. And then we'll also look at some of the more aggressive stuff that I've been doing with structure and price action. So sit back and enjoy, and we'll be right back after that to talk about trading psychology and break down the equity curve a little bit. And one thing we talked about in the live room is if I were a day trader, a trader that traded the daily chart, I should say, if I was a trader that based his trades off the daily chart, I would have gotten short next bar market after this big red candle. After this candle right here, I would have gotten next bar market. And what I did was, I'm not a trader that uses the daily chart to enter a trade. So I go down to the 240. And what I was looking for on the 240 was some type of double top or the same type of formation on the 240. However, we didn't get that. On the 240, we had a higher high, higher close from our structure level right here. So you can see it was interesting that I was getting two different signals on the same pair. On my higher time frame, I was getting an aggressive sell. On my lower time frame, we didn't get that higher high, higher close, so I was using caution, saying, well, on this time frame, it is setting up for a trend continuation move. So we know, and I think we had double topped at that time as well. So we asked ourselves, is there anything we can use to help out with this scenario? And I went through my mind. I don't want to break my rules. The higher time frame gives me a good time, but I want to break my rules on my trading time frame. What can I do? I don't want to hop into the trade emotionally. What can I do? And we remember a technique that we learned. Some of you learned it a while ago. Some of you learned it, a few months ago when we did our free YouTube training. But the 2618 technique, when the market comes up, when we double top, in this case we triple top. When we double top, we wait for a break and close below the lows of that double top here, which we got with this nice red candle here. Wait for a break and close below that. Then we wait for a retracement back into previous structure and or the 618. And we're looking at our 618. Our 618's out here at 102.77. So you look for a retracement back into that 618 or structure, all depending on how you worked it out. And then we look for a move back down. And that was my way of getting in the market, again, because I couldn't get in the other way. But if I got a second chance, I'd be able to jump on it. So we've got a potential 2618 setting up here on dollar yen. Pound Swiss here on the hourly, looking at, double top right here, previous structure highs. RSI did go overbought. Boom. Oh. RSI went overbought. I'm getting used to these shortcuts. Overbought. We've got structure looking left. I already have apparently I did research on this already, so I've already got a yellow box around there. Yeah. Let me ask you this, Bill, or anyone in the room. Let's talk about it. Stops and targets. Where are we putting them at? Stops and targets. Let's discuss this. I'm gonna get this over to the syndicate just so they have a look at what we're watching. But let's hear some ideas for stops and targets. This may even be a harmonic move. Look at that. Oh, look at that. Not an ABCD pattern, guys. Not an ABCD pattern, but a harmonic move. $382 from structure. 382 from I'm guessing the lows mark. Well, Denny, what are our rules on a retracement for a ABCD pattern? And when I say we, I mean I. Because I shouldn't assume that anyone, Yep, exactly. All right, so taking a RSI, taking a Fibonacci from our swing lows to our swing highs here. Looking for that 382, 5305, right above that 53 even handle. We've got structure a little bit lower, but I think we all agree 5305 is a better spot than 5295, right? Psychological numbers. Let's look left. Does structure leave clues? Ooh, it does. Ooh, it does. Look at this. Look at this. 1, 2. We can call it 3. 3 levels right there. I think that's a good level. I think that's a much safer level than being under the 53 even handle. So we want to measure that out. And again, we still have 15 minutes, guys. We still have 15 minutes left. We want to measure this out, and we say, okay, well, targets are looking to be right here. Let's copy and paste this 3 times. Look at that. Ninja loves me today. This is great. And we can compare our risk reward based on the stop that we're using. Guys, this is why it's important. It's important to understand the market. If you can understand the moves that the market has made and understand what those moves mean, it's a lot easier to set up your next trading opportunity. And again, get that confirmation bias and really lock on one type of trade. When I see that break and close below, the one thing I think is lower low, lower close. The trend should continue in that direction. Right? We should come down to our next structure levels, which are going to be support down here and then support down here and then support a little lower. So we should continue lower with this type of movement. So what that does is it blocks out any type of bullish trade for me. I don't care about any type of bullish trade. We can make a reason to trade at any given point in the market, bullish or bearish. I say that all the time because it's true. I promise you that. But we don't want to. We want to find the highest probability trade. So I'm identifying what the market is doing. I'm saying bearish market for most recent price action. I only want to spend my energy focusing on bearish trading opportunities. So I go down one more time frame, and then I see this. I look at a smaller ebb and flow. I see the market. We can take this minor ebb and flow, new structure low, outside return right here, new structure low. Right now we're putting in an outside return. If the market is going to continue down, then this structure level should not be broken and closed above. And I take a look at that wick from our previous candle again, and look at this. Big wick up, spiking, telling me there's some selling pressure up here. We get a close below this structure level. We attempted that again on our last bar market. We still haven't been able to close above the structure level. I think the wick is up here somewhere, wherever I measured this line up. So what I did was I took a short opportunity in anticipation that we're going to see a move to the downside. Great risk reward here. I'm looking at targets down here at whatever this is, 71.80 something. I'm used to using my crosshairs. It's a lot easier that way. Looking at targets down here at 71.87. Similar. This is very similar to the Euro Yen one I showed you guys earlier in the week. Looking at potential targets looking like this. And we're looking at a stop loss being just right over previous structure highs. Because again, if we get a higher high, higher close above this red line, then guess what? The trade's invalid. At least at this point, we can still go short, but based on the area that we entered at, our trade's invalid. So very, very small stop losses here. So getting a nice 2-to-1 risk reward. And that's something I like to have. All right, guys, so I hope you enjoyed that. Now, what I want to do now is dig a little bit deeper into the equity curve. And just to give you some historical perspective, I'm about a 3% trader, meaning that month over month, I average 3% in the market. Now, that 3%, I don't get 3% each month. Some months are 10%, some months are minus 7%. It goes up and down. But at the end of the day, it's an average, nice smooth average of about 3%. Now, I know some of you out there that may be new to the channel, new to trading. You're snickering. You're like, hey, who is this clown? 3%, what is that? That's garbage. Instead of getting in an argument about that, here's what I encourage you to do. I encourage you to go talk to a professional trader. And I'm not talking about your average Joe on the internet that's in a trading forum that's selling an indicator promising 80% returns a month. I'm not talking about that. I'm talking about a real professional trader, and ask them what they consider a quality ROI, return on investment per month. And I think you'll come back, and I think you'll leave that conversation rather surprised and a lot more educated. Leave it at that. The point I want to show you is within that smooth equity curve, within that nice, easy 3% each month rise up, the day-to-day trading and the trade-by-trade trading often gets pretty choppy. And this is where it really challenges your psychology. And just walking you through my week right now, here's what we had. Started off the week with a bang. Up 125 pips between Sunday and Monday. I had some trades that rolled over from Friday, entered a few other trades on Sunday, and you know, had a pretty good outing to start the week. Gave myself a pretty good cushion, which you can later see I needed. Tuesday, as expected, I gave some back. Whenever I hit a hot streak, I tend to give some back, so I expected that. And then we channeled a bit. Put in a little consolidation, win-loss, before making my way on Wednesday up towards new equity highs, or previous equity highs, I should say. Then it happened. And by it, if you guys are in the syndicate, you know exactly what I'm talking about. Trading room members, you know exactly what I'm talking about. If you are involved in the market in any type of way on Wednesday around noon, you know exactly what I'm talking about. For some reason, and I still haven't figured out what that reason is, I'm just going to blame Russia. When in doubt, blame Russia. The markets jumped about 50 pips. And I'm not talking just the euro, but the euro, the dollar, Aussie pairs, yen pairs, Kiwi pairs, pound pairs. These pairs just jumped about 50 pips, similar to what we would see on a non-farm report. They jumped, and then they came right back up to where they were before, and the market went on its way like nothing happened. Unfortunately for me, those 50 pip jumps stopped me out of 3 trades, sending me into about 100 pip drawdown, or over 100 pip drawdown. So I got hit pretty hard on that, unfortunately. And then eventually I re-entered those trades again after it was literally, go back and look at it, the market spiked down and came right back up. So I re-entered those trades. That's a rule I have. If I see something irrational, if I see something, impulsive movement like that, I'm allowed to do that depending on the close at the top of the hour. So I re-entered it and made some money back, and that's where you see the spike back and really fought myself out of a hole that I didn't need to be in. Now, what I want to show you, and I want to say this, this is not the best looking equity curve in the world, trust me. But the point is, I ended in profit and I traded my way out of a drawdown to end making money at the end of the week. We still have tomorrow, but as of right now, making money at the end of the week. But let's say that spike didn't happen, and I'm not using that excuse, but let's just say it didn't happen because it was, again, impulsive. I don't know why it happened, but it happened and the market ignored it. But if it didn't happen, my equity curve would have looked a lot different. And what I'm going to do here is I'm going to take out 3 of my losses. Now, I say I took 4 losses during that spike. One of those trades would have ended up losing anyway, whether the spike happened or it didn't happen, because it never got the profit and went down to my stop loss. So I'm going to keep that loss in there. But let's say I take away 3 of those losses. Look at the difference it makes to my equity curve. We still spike up. We still have that consolidation period. But instead of having that dip lower, we now have new equity highs followed by a retracement. So it's still not pretty, guys. It's still not a straight shot up. You can still see it's still a grind no matter what. Even if you're not taking that, those chunks of losses in a row, it's still a grind. And it's really important that mentally you work your way through it. And I read a great article in Wall Street Journal this week, talks about pessimism versus optimism. I'm not sure if you guys can see this. I'll throw it up. But it was talking about, what is it better to be? Is it better to be pessimistic? Is it better to be optimistic? And at the end of the day, they came to the conclusion that really you need a little bit of both. And they related to life and dying earlier and stuff like that doesn't matter. I'm worried about trading, all right? I'll die when I die. I worry about trading. So I'm looking at it as a trading perspective. If someone is too optimistic, they're going to catch this hot streak at the beginning of the week. And what are you going to do? You're going to throw your cape on. You're going to start flexing your muscles. You're going to start feeling like Superman. You're going to start thinking, I can't lose. I'm invincible. And that's going to lead to making some trading mistakes. You're going to start taking trades before they hit the level that they're supposed to. You're going to start moving targets further away because you feel like the market's going to go wherever you think it's going to go. And eventually that's going to come back to bite you in the butt. Same thing if you're too negative. If you're too pessimistic, you're going to hit this drawdown right here. And instead of trading your way out of it, dealing with a little pain going sideways from trade 7 to trade 17, instead of going sideways like that, you're going to start giving up. You're going to say, well, the market's out to get me. I know I'm not going to win because the last 4 trades lost, blah, 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 blah. And you're never going to give yourself a chance to recoup some of those losses, where if you would have just continued to trade through your plan and keep taking what you're supposed to take, you would have. And what's worse is people that do that, even if you are still taking trades, what I usually see with my clients is that you'll take a trade, but then, say your target is about, 70 pips away. The market says you're up 25. You start doing something like this, looking around. No one's watching. Exit position. Woo, up 25 pips. Woo, yeah. You start cutting yourself short. You start cutting your own legs off in your trades. Again, not giving yourself the chance to make these new equity highs. So I thought it was a cool article just showing that you got to be somewhere in the middle. You can't be over optimistic. You can't be over pessimistic. You got to have a little bit of confidence. You also got to have a little bit of doubt or realism, I guess, whatever you want to call it. And following up on that, I want to share one last thing with you before we head out. And it comes from the book Pitbull by Martin Swartz. Let me actually go grab that. Great book I've been reading, Pitbull by Marty Schwartz. And I just finished chapter 7 where, long story short, he was on the opposite side of the market. The market was going up, 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 up like it couldn't be stopped. He had his mindset on a short position and kept dumping money in short. It's going to reverse eventually, dumping more money in, more money in, to the point where he went to bed at night and his position was down about $1 million. Yep, $1 million. And at the end of that chapter, it was with how do you deal with that losing streak once you're in too deep? And I think we've all been there. We've all been in the revenge mode where we're in too deep that we feel we can't get out. And I won't read it to you, but I'll put it up on the screen and you can pause the tape and check it out. But it's just a really good passage on losing streaks and how every trader deals with them, and kind of some tips on how to get through them and what to do if you face it. So again, pause the tape. I think each and every one of you should read this. I thought it was fantastic, and I thought it was worthwhile to share with you guys. So that's it for this week, guys. What else? What else am I forgetting? Oh, well, if you got live room members, and I guess syndicate members too a little bit. We've been doing a lot more in the live room than in the syndicate, just because it's a different type of program. The syndicate only allows for so much. The live room we can do a lot more, but we've been doing a different type of analysis in the live room. Again, I've been backing off the day trading, doing more intraday type trading, and trying to talk about the psychology of the market more, and what the movement means to me. And I've been doing this for a few reasons. Mainly it's because the members, the core group that is coming through my training course, the 12-week transformation, the core group is just about ready to graduate. I think you guys are officially done, but we're giving you an extra week. But you're about to graduate, and we're at the point where we went from the basics of price action analysis, reading a chart, which you guys thought were boring. We went to that, to advanced patterns, which you thought were cool because you can directly relate it to making money. And then we wrap things up by putting it back together and ending on price action analysis and how to use that trading wise. So what I want to do is, before you guys leave, I hope you guys stay in the live room or in the syndicate or in both. But for you guys that are leaving and becoming independently, consistently profitable traders, I want to give you as much as I can psychologically before you guys head out, just so you can really understand the ebbs and flows in the market and really understand how to take everything that we've been doing and put it together into a multiple, so you can be a multiple strategy trading beast, essentially. So let me know if you've been liking that. Obviously, we've been making some good profit off of it, or I've been making some good profit off of it, but let me know if you like that by leaving me a comment. And just in general, if you're in the syndicate as well, leave me a comment under this video. Let me know what you've liked. Let me know what you've disliked. I'm always working on, just as with my trading, I'm working on trying to get better, as a teacher as well. So if everything's good, just leave me a comment saying, hey, Kill, love it. It's all good. If there's something you don't like, do me a favor. Just be constructive. Leave constructive criticism. Don't just be like, man, Akil, you stink. First of all, that doesn't tell me how to get better. Second of all, if you stink, just leave. Just don't. Why are you still involved with me if I stink? So be constructive. Say, hey, I like this, but hey, can you maybe try some of this, try some of that? I can't make any promises on what I can and can't do. Again, both programs are a little different. I can do a lot more in the training than I can in the live room. I can do a lot more in the live room than I can in the syndicate. It's just how they're based. Syndicate is entry level, and then you work your way up. But I'm all ears, and I'm always trying to get better in all aspects of my life, of my trading, and in my teaching. So until next time, guys, plan your trade your plan. Friday, let's go rock the market, end the week with a bang. Syndicate members, I'll see you for the weekend review. Or not weekend review, I'll see you for the War Room meeting. Oh, how about pound yen this morning? Nailed it. Crushed it. 45 pips. Woo! Sorry, I'm excited. I get off track. We nailed that trade this morning, though. But anyway, I'll see you guys next time. Have a great day. Thank you for joining me once again. Like, subscribe, share.